Hey everyone, it's Nick from Share Dividend here, and in today's video we're going to be talking about the 15 owner-related business principles of Warren Buffett. Now, before I get into the video, I just want to invite you to subscribe to our channel because we're really hoping to put out some more fantastic content throughout 2018. Now, before we talk about Warren Buffett's business principles, it's nice to start with a little introduction of who Warren Buffett is. Most people know him as the chairman and chief executive officer of Berkshire Hathaway, which is a big investment conglomerate that owns businesses like Dairy Queen, Fruit of the Loom, and Geico Insurance. That alone does not really make him worth study, but it's his track record that really stands out. Since taking control of the company in 1964, Buffett has grown Berkshire Hathaway's book value per share by about 19% per year, which represents a cumulative gain of about 884,000%. Warren Buffett's done this by a combination of owning entire businesses and also purchasing marketable securities and holding them for the long run. Warren Buffett has an investment portfolio that's worth about $100 billion, and we actually maintain a database of this investment portfolio that you can download on our website. So I'll toss a link in the description for you to access that. So the first principle we're going to talk about is the principle that the shareholders own the business. And this principle is best illustrated with this quote. We, Warren Buffett and Charlie Munger, do not view the company itself as the ultimate owner of our business assets, but instead view the company as a conduit through which our shareholders own the assets. Now, what does this mean in practice? Well, it means that Buffett looks to maximize shareholder value, not corporate size. And while it might not be clear on the surface how those two things are different, there's actually some distinct differences. Keep this principle in mind as we go through the other principles in this video, and it'll start to tie things together into this cohesive investment framework. The second principle is that the managers of the business own a stake in that business. And this principle is best illustrated with this quote from Buffett. Most of our directors have a major portion of their net worth invested in the company. We eat our own cooking. Now, this principle is important because it aligns shareholder returns with management returns. If the company's management has a large stake in the company, they are far more likely to maximize shareholder returns because they are the shareholders. The third principle is related to the second principle. The third principle says the goal is to maximize long-term growth in intrinsic value per share. Buffett formalizes this principle with the following quote. We do not measure the economic significance or performance of Berkshire by its size. We measure per share progress. Now, this is a little bit of an abstract concept, but I find the most helpful way to understand it is by considering the following analogy. What is the difference between owning 10% of a $1 million business or owning 1% of a $10 million business? Now, it's kind of a trick question because there really is no difference. While one business is far greater in size, you own a much smaller proportion of it, and your fractional ownership is actually the same size in either case. This is why it's important to have a focus on per share value, which is an ideology that differentiates Warren Buffett from many other corporate CEOs. Now, the major way to destroy per share value is by issuing company stock. Buffett has talked about this a lot in his annual reports, and one of the best quotes we found is the following. Unfortunately, I followed the Geico purchase by foolishly using Berkshire stock, a boatload of stock, to buy General Reinsurance in late 1998. After some problems, General Re has become a fine insurance operation that we prize. It was, nevertheless, a terrible mistake on my part to issue 272,200 shares of Berkshire in buying General Re, an act that increased our outstanding shares by a whopping 21.8%. My error caused Berkshire shareholders to give far more than they received, a practice that, despite the biblical endorsement, is far from blessed when you're buying businesses. Buffett follows that up by saying the following. Early in 2000, I atoned for that folly by buying 76%, since grown to 90%, of Mid-American Energy, a brilliantly managed utility business that has delivered us many large opportunities to make profitable and socially useful investments. The Mid-American cash purchase, I was learning, firmly launched us on our present course of 1, continuing to build our insurance operation, 2, energetically acquiring large and diversified non-insurance businesses, and 3, largely making our deals from internally generated cash. Today, I would rather prep for a colonoscopy than issue Berkshire shares. Now that emphasis is ours, but I think that if Buffett were reading it, he would place emphasis on the same sentence. The fourth owner-related business principle of Warren Buffett is this. Own cash-generating businesses with above-average returns on capital. Buffett formalizes this principle with the following quote. Our preference would be to reach our goal by directly owning a diversified group of businesses that generate cash and consistently earn above-average returns on capital. In the history of Berkshire Hathaway, there's no better example of this than the purchase of See's Candies. The company's remarkable history is explained in the following quote from Warren Buffett. See's sold 16 million pounds of candy in 1972. In 2007, it sold 31 million pounds. That's a growth rate of about 2% annually. Yet the business created tremendous value. How? Because it generated high returns on invested capital and required little incremental investment. Growth creates value only when a business can invest at incremental returns higher than its cost of capital. The higher return a business can earn on its capital, the more cash it can produce, the more value is created. Over time, it is hard for investors to earn returns that are much higher than the underlying business's return on invested capital. So what stops CEOs and other investors from purchasing such high-quality businesses? The trouble is that they usually command a premium price, and value-focused investors aren't willing to pay up for these high-quality stocks. Buffett later wrote the following about See's candies. Blue Chip Stamps bought See's in early 1972 for $25 million, at which time See's had about $8 million of net tangible assets. Throughout this discussion, accounts receivable will be classified as tangible assets, a definition proper for business analysis. This level of tangible assets was adequate to conduct the business without use of debt, except for short periods seasonally. See's was earning about $2 million after tax at the time, and such earnings seemed conservatively representative of future earnings power in constant 1972 dollars. Thus, our first lesson: businesses logically are worth far more than their net tangible assets when they can be expected to produce earnings on such assets considerably in excess of market rates of return. For those of you unfamiliar with the history of Berkshire, Blue Chip Stamps is a related entity that Berkshire acquired in whole later on. The big lesson to take away here is that sometimes a great business is worth paying a not so great price for. The fifth owner-related business principle of Warren Buffett is to give investors data that matters. This quote underscores this principle nicely. We believe in telling you how we think so you can evaluate not only Berkshire's businesses, but also assess our approach to management and capital allocation. Berkshire provides far more information than is legally required on the company's operations in its annual reports and other filings. With that said, they avoid forward-looking projections and don't really provide earnings estimates or guidance. The company's communications tend to be focused on philosophy and big-picture items, not tiny details that don't actually provide much value to shareholders and analysts. The fifth owner-related business principle is to maximize intrinsic value and not accounting value. This quote explains this principle nicely. Accounting consequences do not influence our operating or capital allocation decisions. When acquisition costs are similar, we much prefer to purchase $2 of earnings that is not reportable by us under standard accounting principles than to purchase $1 of earnings that is reportable. The underlying theme that makes this principle important is that accounting gives only a rough estimate of what a business is actually worth. Buffett believes that economic earnings are often different than accounting earnings. Truly understanding how a business operates and how it works can help you to understand what the most useful metrics are in most investment cases. The next principle that we'll talk about is to use debt conservatively. Here's Buffett's thoughts on the matter. The financial calculus that Charlie and I employ would never permit our trading a good night's sleep for a shot at a few extra percentage points of return. Debt is dangerous. It uses future earnings and uses them in an attempt to grow faster now. Berkshire's leverage metrics are quite low for a large corporation, and this is because Buffett avoids debt wherever possible. The next slide has a long quote to help us understand why. The fundamental principle of auto racing is that to finish first, you must first finish. That dictum is equally applicable to business and guides our every action at Berkshire. Unquestionably, some people have become very rich through the use of borrowed money. However, that's also a way to get very poor. When leverage works, it magnifies your gains. Your spouse thinks you're clever and your neighbors get envious. But leverage is addictive. Once having profited from its wonders, very few people retreat to more conservative practices. And as we all learned in third grade, and some relearned in 2008, any series of positive numbers, however impressive the numbers may be, evaporates when multiplied by a single zero. History tells us that leverage all too often produces zeros, even when it's employed by very smart people. Leverage, of course, can be lethal to businesses as well. Companies with large debts often assume that these obligations can be refinanced as they mature. That assumption is usually valid. Occasionally, though, either because of company-specific problems or a worldwide shortage of credit, maturities must actually be met by payment, and for that, only cash will do the job. Borrowers then learn that credit is like oxygen. When either is abundant, its presence goes unnoticed. When either is missing, that's all that is noticed. Even a short absence of credit can bring a company to its knees. In September of 2008, in fact, its overnight disappearance in many sectors of the economy came dangerously close to bringing our entire country to its knees. Charlie and I have no interest in any activity that could pose the slightest threat to Berkshire's well-being. With our having a combined age of 167, starting over is not on our bucket list. We are forever conscious of the fact that you, our partners, have entrusted us with what in many cases is a major portion of your savings. In addition, important philanthropy is dependent on our prudence. Finally, many disabled victims of accidents caused by our insureds are counting on us to deliver sums payable decades from now. It would be irresponsible for us to risk what all these constituencies need just to pursue a few extra points of return. So that summarizes the debt-based principle of Warren Buffett. The next principle is about ego. More specifically, Buffett believes that you shouldn't grow the business to satisfy your own ego. This is related to the previous principle we talked about on creating value on a per-share basis. Corporate managers are often tempted to grow the size of their total business, regardless of per-share value, because it leads to more prestige, a higher salary, and often larger bonuses. This is the wrong approach, and the way that it's usually implemented is by issuing stock to acquire other companies. Here's what Buffett says about that. Finally, a word should be said about the double whammy effect upon owners of the acquiring company when value-diluting stock issuances occur. Under such circumstances, the first blow is the loss of intrinsic business value that occurs through the merger itself. The second is the downward revision in market valuation that, quite rationally, is given to the now diluted business value. For current and prospective owners, understandably will not pay as much for assets lodged in the hands of a management that has a record of wealth destruction through unintelligent share issuances, as they will pay for assets entrusted to a management with precisely equal operating talents, but a known distaste for anti-owner actions. Once management shows itself insensitive to the interests of owners, shareholders will suffer a long time from the price-value ratio afforded to their stock relative to other stocks, no matter what assurances management gives that the value-diluting actions taken was a one-of-a-kind event. Next up, we have a principle about dividend payments. Buffett believes that corporate managers should only retain earnings when they can generate positive returns. And here's Buffett's test on whether Berkshire should continue doing so. He says, we test the wisdom of retaining earnings by assessing whether retention, over time, delivers shareholders at least $1 of market value for each $1 retained. Now, actually, that's a vague summary of his test, and he later provided much more clarity. The test is based on a 5-year period, and here's what Buffett says about it. The 5-year test should be, 1, during the period, did our book value gain exceed the performance of the S&P 500? And 2, did our stock consistently sell at a premium to book, meaning that every $1 of retained earnings was always worth more than $1? If these tests are met, retaining earnings has made sense. While many companies pay dividends, Berkshire seems to be one of the only publicly traded companies that seriously considers whether it's the right choice for their shareholders. Principle 10 says, only issue new shares if they are fairly valued or overvalued. Here's what Buffett says about this. We will issue common stock only when we receive as much in business value as we give. This is a really important principle because issuing common stock reduces each investor's fractional share of business profits and assets unless the rising share count is met with an even faster increase in earnings and book value. What this means for corporate managers is that the choice to issue shares is price dependent. Issuing overvalued stock actually builds shareholder value because you're receiving more cash for every share than what those shares are actually worth. The complete opposite of that is issuing undervalued shares. In that case, you're receiving less cash for each share that you sell than what those shares are actually worth, which destroys shareholder value over time. The 11th owner-related business principle of Warren Buffett is to never sell a good business. Here's what Buffett says about this. Regardless of price, we have no interest at all in selling any good businesses that Berkshire owns. We are also very reluctant to sell subpar businesses as long as we expect them to generate at least some cash and as long as we feel good about their managers and labor relations. Now, an important distinction here is that this applies for Buffett to both wholly owned subsidiaries and marketable securities. Buffett is famous for buying a business and holding it for decades, and that applies to owning the entire business or owning just a fractional share of it through stocks. This Buffettism summarizes this nicely. Inactivity strikes us as intelligent behavior. Neither we nor most business managers would dream of feverishly trading highly profitable subsidiaries because a small move in the Federal Reserve's discount rate was predicted, or because some Wall Street pundits had reversed his views on the markets. For investors, the main takeaway here is to think for the long term and hold businesses far longer than most people do. The 12th owner-related business principle of Warren Buffett is to inform your shareholders, not mislead them. Buffett says, "We will be candid in our reporting to you, emphasizing the pluses and minuses important in appraising business value. Our guideline is to tell you the business facts that we would want to know if our positions were reversed." This is a pretty straightforward concept. Buffett believes that corporate executives should be honest with their shareholders. Honesty is important because a management that deliberately misleads its shareholders wastes time and effort on bending the truth. This energy should instead be focused on maximizing shareholder value. The 13th principle says, don't give competitors your best ideas. Buffett says good investment ideas are rare, valuable, and subject to competitive appropriation, just as good product or business acquisition ideas are. Therefore, we normally will not talk about our investment ideas. The last principle we talked about discussed being candid with shareholders. Principle 13 explains the limit of this candor. Managers should tell shareholders the philosophy and guiding rules that they use to run their business, but they should not tell them the exact and specific details. The 14th principle says, it's as bad for your stock to be overvalued as it is to be undervalued. Buffett says, our "it's as bad to be overvalued as to be undervalued" approach may disappoint some shareholders. We believe, however, that it affords Berkshire the best prospect of attracting long-term investors who seek to profit from the progress of the company rather than from the investment mistakes of their partners. Buffett recognizes that an overvalued stock attracts the wrong kind of investor. He looks for shareholders with a long-term approach because that aligns them to benefit from the long-term intrinsic growth in the business and not day-to-day fluctuations in stock prices. The last and 15th principle that we'll talk about is that long-term value growth should outpace the S&P 500. Buffett says we regularly compare the gain in Berkshire's per-share book value to the performance of the S&P 500. Over time, we hope to outpace this yardstick. Otherwise, why do our investors need us? This is really profound. The long-term intrinsic value growth of a business should grow faster than the S&P 500 over a several-year period. If not, investors should sell this business and instead put the proceeds into low-cost index funds that are almost destined to match the market before taking a slight fee. In this video, we talked about 15 distinct owner-related business principles of Warren Buffett. These principles can be summarized with the following sentence. Look for a management team that seeks to maximize long-term per-share intrinsic value that is operating a high-quality business that treats shareholders as business owners. For investors, the actionable way to apply the principles that we discussed in this video is to look for a business with the following qualities. A high-quality business with strong competitive advantage, management that does not take excessive risks, management that places emphasis on shareholder value, management that is skilled in capital allocation, and management that seeks to maximize per-share intrinsic value. That's it for today's video. Thanks for watching. Please take a moment to subscribe to our channel if you found this video beneficial.